Well, hi, everybody, and welcome to the Buffett and Beyond Stock Analysis Video Podcast with your host, Dr. Joseph Belmonte, which is me, and Debbie with a Y. Hi, Debbie.
Just me. Hello.
And all these methodologies are based on the book Buffett and Beyond, second edition by Dr. Joseph Belmonte and published by Wiley Publishing. And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. Now remember, folks, the clean surplus return on equity is both a comparable and a predictability model and is totally different than the traditional accounting return on equity. So don't get them mixed up. And you can equate the clean surplus return on equity as the interest rate you get from a bank. So this is common sense now. A bank account with a higher return or interest rate will earn you more money than an account earning a lower interest rate. So it just follows that portfolios made up of stocks with high clean surplus ROEs or return on equity will outperform other portfolios made up of stocks with lower return on equity or interest rate. So think of your bank account when we talk about these stocks. The good.
Stocks that should be in our portfolio.
The bad.
Stocks that should be in somebody else's portfolio.
And the ugly.
Oh, stocks that should be in nobody's portfolio.
Okay, let's get on with some stocks. You'll see exactly how this method works and how we here at Buffett and Beyond set the investing parameters so that you, all of you, can outperform most of the professional money managers out there in investment land. All right, Debbie, let's go over our first stock of the day, and that is AutoZone.
Alrighty, as mentioned, AutoZone Incorporated is the leading retailer and distributor of automotive replacement parts and accessories in the United States. The company operates 5,618 stores in the U.S. and Puerto Rico, 564 stores in Mexico, and 20 stores in Brazil. Each store carries an extensive product line for cars, sports utility vehicles, vans, and light trucks, including new and remanufactured automotive hard parts, maintenance items, accessories, and non-automotive products. They employ over 90,000 people.
Yeah, that's a big company, folks. Yeah. And the first thing we want to look at is the clean surplus return on equity. And remember, we equate this to a bank account with the average bank out there, the S&P 500, paying about 13% ROE, and AutoZone with a 15.2% ROE projected for 2020. Now, back in 2012, 2013, this stock had an ROE, clean surplus ROE, of over 20%. And ever since then, it has been declining. But these automotive parts stores are somewhat recession resistant because during recessions, people will fix up their cars or have their cars fixed up rather than go out and buy a new one. So that's very, very important with these stocks. And I'm going to show you a slide right at the end of this, and we're going to compare how these stocks did during 2008 and 2009 when we had the market down as far as 50% in the S&P 500. Now, the good thing about AutoZone, even though that ROE is declining, it's still above the average stock, and we would expect it to do better than the average stock out there. And when we go to the one-year returns, oh my gosh, look, with the market up about 4%, this stock is up about 62% in the past year. And folks, that's why we're talking about recession resistance, because look over here, and those of you who are just listening to this can't see this, but back in September, October, November, and December, when the market was going down and it hit a low on Christmas Eve, this stock not only stayed the same but actually went up a bit. But overall, during that whole market decline, this stock did not decline and in fact went up. And after that decline, starting the new year, this stock just took off like a rocket, up another 30% for 2019 and up 62% over the past 1 year. And when we look at the past 5 years, we see this stock up about 100% with the market up about 45%. So it's doing twice as good as the market. And as you can see, if you are looking at this, you can see it's had its ups and downs, but this stock is really good when the market declines. Okay, Debbie, let's go over O'Reilly Automotive.
O'Reilly Automotive. They supply aftermarket auto parts, tools, equipment, and accessories to both do-it-yourselfers, as I once was.
Yeah, I remember.
I was.
I don't know if you know this, but Debbie used to race cars back in the day.
Yes, after I rebuilt the engine. Not today, though. But the do-it-yourself customers, professional mechanics, and service technicians. They also provide services including used oil battery recycling and wiper and bulb replacement. They operate 5,019 stores and 27 regional distribution centers in 47 states. They have 75,289 employees, including 29,849 part-timers.
Another very big company, folks. 100,000 people, over 100,000 people. And as we go over the numbers on O'Reilly, you can see O'Reilly had been in the 20% ROE until just recently, and this year projected to be 18.3%, and for 2019 projected to be 19.7% for the rest of this year, and next year 18.3%. So it's still way up there and higher than AutoZone. So let's take a look at how this stock has done over the past year, up about 37% with the market up 4 or 5%, and over the past 5 years it is up 150% with the market up about 45%. So O'Reilly is doing very, very well. And if you are watching this, you can see O'Reilly during last year, September, October, November, December period. This stock stayed relatively flat while the market was down 20%. So yeah, again, O'Reilly and AutoZone are considered recession-resistant stocks. And let's go over our last stock of the day, and this is Copart. And this suggestion was sent in by Mike, and Mike says, hey, you better take a look at this stock. It looks pretty good. And we're going to look at the numbers right after Debbie tells us what it's all about. And as she reads it, you can see it's a little bit different than AutoZone and O'Reilly. They have a different take on the automotive business.
All right, a different twist. Copart is a leading provider of online auto auctions and vehicle remarketing services in the U.S., 83% of 2018 revenues, and internationally. Acts as an intermediary between sellers, primarily insurance companies, and buyers, dismantlers, used car dealers, exporters. Most vehicles sold on behalf of insurance companies are either damaged and or deemed a total loss or recovered stolen vehicles on which a settlement has been made. Revenues are generated from auction listing fees as well as from storage and transport. They only have about 6,000 employees.
Yeah, and you can see this is a much smaller company than O'Reilly and AutoZone, but they have a different twist on the automotive business, as I mentioned, and now we're going to look at the numbers and see exactly why Mike was so excited about this stock. And looking at Copart, we can see something with this clean surplus ROE projected to be 18.8% for the rest of this year, 2019, 18.1% for next year, 2020. And when you equate the clean surplus ROE to your bank account, the average stock bank account, or S&P bank account, as we like to call it, of 13.5%, and Copart, which has a different twist, online auctions, than does AutoZone and O'Reilly. But you can see this ROE is rising, so the market likes a rising ROE. Now, what does this mean? It means that the net income or earnings are increasing each year, but they are increasing at an accelerating rate. It's just like a race car going around a track, and each lap it goes around, it picks up a little bit more speed. That's the car that's going to win this race. And again, this stock is not paying out a dividend, so it's putting all the money back into itself in order to grow, and it is growing by acquisition and also by building new facilities to store those cars that it takes and then auctions off or sells to distributors out there. And just like the other two stocks that we are going over today, the debt is very, very low. And remember the years to pay debt. Buffett likes to see a company that can pay off its debt in 5 years or less. And what this means is if it takes all the money it's making in order to pay off its debt, how many years will it take to do that? His rule of thumb is 5. Our rule of thumb is 2 or 3. And this stock, as well as AutoZone and O'Reilly, have very, very little debt. Over 5 years, this stock is up 300%, folks. It is really, really doing well. Difficult thing that we have with this stock, it is not recession proof like the other two stocks. Look at the last quarter of 2018, folks, and we can see this stock dropped just like the market dropped. In fact, it dropped further than the market. So it is not recession proof. In other words, people slow down in their buying of cars, and so Copart sells less cars to the distributors out there. Now let's look at these three stocks together, and when we look at the 2020 expected return on equity with the market averages 13.5%, in other words, this is bank account S&P 500, 13.5%. All of these three stocks have ROEs greater than the market average. Net income growth, all three companies are above, with Copart leading the way, O'Reilly second, and AutoZone third. Revenue growth, again, all above the average stock. So all of these three stocks are doing good, with AutoZone and O'Reilly recession proof or recession resistance, and Copart having the only stock out of these three with an increasing return on equity, while AutoZone and O'Reilly have a decreasing ROE, with O'Reilly being the better of the two stocks. And I'm talking about O'Reilly versus AutoZone. O'Reilly has better numbers all the way around. When we look at the past 5 years, we can see Copart is actually outperforming AutoZone and O'Reilly, but AutoZone and O'Reilly outperforming AutoZone, and AutoZone outperforming the S&P 500. So these three stocks with ROEs above the average stock in the S&P 500 are outperforming the S&P 500. So the clean surplus numbers are working very well with these three stocks. And when we look at a chart of 2008, and this is June 30th of 2008 till March 30th of 2009, and in the first quarter of 2009, this is when the market hit a low of almost 50%, and that is the black line on this chart. And we can see O'Reilly and AutoZone are recession resistant, because during this time when the market was down as much as almost 50%, these stocks were up. AutoZone 35%, O'Reilly up almost 60%, but Copart followed the market down. So here we go. The dilemma is that Copart is performing better. It has a unique business model in that it's different than AutoZone and O'Reilly, but it is not recession proof. But it is outperforming. When we look at the 5-year returns once again, you can see that Copart is up 300% with the market up about 45%. And we can see O'Reilly outperforming AutoZone handily, and all three stocks outperforming the S&P 500. So you got three good stocks here, folks, with O'Reilly being the recession-proof stock and AutoZone being the recession-proof stock, where Copart will go down with the market. But folks, we have three good stocks here.
Well, JB, I think we've just about covered all the questions sent in by our listeners out there in investment land. And remember, folks, we're here to answer your questions not only about individual stocks, but also about the stock market in general. So keep those questions coming, and who knows, we may even answer a question or two you didn't even know you had. And that's about it for today, JB.
Okay, folks, we had a great day today.
And tomorrow will be even better.
All right, bye, folks. We'll see you next time.
Bye, everyone.
And remember, folks, if you want to live on the beach like Jimmy Buffett, you've got to learn how to invest like Warren Buffett. We've had a good week, folks, and here's hoping that next week will be even better. You have a safe weekend, and we will see you next time.